computer. All right. Hello, everyone, and welcome. Rada Milanovic, the Director of Investor Relations at Ginkgo, and we appreciate everyone joining us here today. We're just going to give it one extra minute, and then we'll get started. So bear with us as folks log in. All right. I'm seeing 1 minute over 1:30, so we'll get started. So, thanks for being here today for Ginkgo REIT's 2024 year-end investor webinar. Today, I'm joined by two of my colleagues here, Bill Green, Principal and Co-CEO, as well as Eric Stamp, our Chief Financial Officer. We have a wide range of topics to discuss today. We'll cover some of our portfolio operation metrics, our capital markets updates, some financials, and we'll also highlight some outlook for 2025. We will also save time towards the end of the presentation to do a Q&A session. So make sure you drop questions in the bottom of the Q&A box below. Also, just some housekeeping. The session's being recorded, so we'll make the replay available for everyone on Ginkgo Vest, and we'll notify everyone via email once that's available. So with that, let's dive in. I'll kick it off to you, Bill.
Thanks, Rada, and thank you everyone participating today. Your input and understanding of our company is really important. So ask questions, filter them to us, and hopefully we can get to them today or in the future if you want to do that. My comments in this presentation today is generally going to relate to our annual results, but I do want to just point out one thing, and that is our revenue, our NOI, our net cash flow after CapEx generally improved in every quarter of 2024, reversing a trend that we had in the second half of 2023. With that, revenue came in and had really nice result for the year. We had noticeable pickup in occupancy toward the end as we entered the second half of the year. While our apartment rent growth slowed a little bit, we had better collections, and we also saw nice results from our renovation of 500 apartments. With that, our net operating income was slightly hampered by property taxes and insurance, something that has been hitting us a little bit over the years. We also had a little pickup in the second half of the year with our maintenance expenses, but that was more than offset by getting reversion to the mean relative to our recurring CapEx, which really got back to historic levels in the second half of the year and really drove what I think is kind of market-leading results for the year with the bottom line pre-interest expense up 7.8%. Nevertheless, interest expenses continue to grow, and we think most of that growth is coming to an end. But we did in 2024 resolve most of our joint venture debt, and by resolve, we either put in place new caps and extended those caps for 1 to 2 years. But in many cases, we actually put 5-year fixed rate debt on, which took a lot of the pain out of that, and it's generally paid for itself already. So we do expect to see a little bit of interest rate expense increase this year, regardless of rates, just given some of the actions we took last year. But we do think most of that adjustment is over. With it, our cash flow after debt service did decline. And part of that was actually the result of increased amortization, but a big part of it was really that increase in interest expense. Again, we think a lot of that is moderating as we go forward. With it for the year, the shareholder return is down 1.1%. And while we're not proud of it, we're not embarrassed by it. And I think what you're going to find is relative to the space, we're correlated the space by direction, but relative to the magnitude, we actually performed really well, and we think that's going to continue as we're getting into the first part of this year. and we're actually seeing very nice results in January and February so far that continues the trend. With it, I want to just talk about kind of our views of where that we are in the market. And these are some themes we've talked about in the past. We're not big interest rate bettors. In fact, we try not to be interest rate bettors. But we think rates at this point, we think they're going to probably continue with a flat to a downward trend. And that's probably at the long and the short end of the curve. Personally, I would love if the short end of the curve was noticeably, gapped out from the middle of the curve. But the fact that it's tending to migrate and hang out, very closely to the 10-year and not really gapping out much or gapping down, I think that's a little troubling, and I'd like to see maybe 50 basis points continued improvement in that so we get back to historic levels. But we do think the general bias is rates will go down. We also think that our regulatory impediments that predominantly came about with collection and eviction practices, they seem to be moderating further in with some of the actions at the state level in North Carolina and South Carolina, but also just practices and things just reverting back to a normal level of payment issues, working with people on payment issues, and getting through the court system. With it, the consumer remains stressed. Inflation, and then really there's a fairly big credit overhang where a lot of people got used to a level of extra expenditures during the early stages of COVID, and ultimately they tried to maintain those, it looks like. And so, as you've probably seen, there's record levels of auto defaults, there's record level of credit card default, and the consumer has just sort of overspent at this point in time. And when we definitely see that, we see maybe not as high balance credits on our balance sheets right now, but we see probably a little bit more frequent small balances, and that's a big thing for us to focus this year. For Charlotte and Raleigh, we have supply headwinds, and even though we don't really compete with those new supply issues directly, we do indirectly. And where we compete with indirectly is on an occupancy basis. So our rents are still 40 to 50% below new deliveries in most cases, depending on high end, low end, et cetera. But that causes a trickle down effect. So the brand new A properties compete against the aging A's compete against the aging B's, and so on and so forth. And we tend to compete more at kind of the solid middle of B minus in workforce housing. So it does get to us. And so with that, we've made some adjustments to actually really move forward with what we think is a more stable growth trajectory in this market. And that is we've slowed our rental growth. We've reduced renewals from a renewal rate perspective. And we think that that's really the key. And that is to get our residents to reside with us longer and improve our occupancy and collection. And the way we've actually improved our collection, and it was somewhat counterintuitive to me, but it was suggested by our team when we said we were going to start to drop rents to get occupancy, is we've actually increased our credit standards. And I think some others are doing that. And so the odd thing right now is we've enhanced our credit standards, but the brand new lease up stuff has actually lowered their standards because it's so hard for them to get tenants. And so it's an interesting conundrum, which I've never seen in my lifetime. But right now we have probably some of the tighter credit standards we've had since I've been at Ginkgo and since Ginkgo's probably been around. With it, it does look like cap rates are plateauing, and the expansion of those cap rates clearly hurt our valuation over the last few years. There's not a lot we can do about it, but they don't seem to be migrating out as far as we originally thought. With rates coming back in, we're kind of trading at a range about 100 to 125 basis points over the 10-year, while historically that's been closer to 200% or 200 basis points. It's somewhat of a lagging indicator. So we do think that rates are going to stay here, maybe nudge up just a little bit. But right now, for the transactions that are happening, and I have just one slide after this before I hand it over to Eric Stamp. But as while these transactions are happening, there doesn't really seem to be as much of a gap, and we still see transactions trading at sub 5% rates with, I would say, not infrequent occurrence. But the big story right now, and this is where we're actually getting very bullish on the market, is Debt maturity sellers are really surfacing. People that have been hanging in there and they were hoping that they were going to be in a 3% SOFR rate right now. It didn't happen. And these parties need to they really need to delever their balance sheet in order to renew their debt or extend their debt. And a lot of them, particularly the traditional syndicated equity, where it was high net worth, oftentimes they just can't do that. And so, just to depict this visually for you, this is a single market, but this is fairly indicative of the state. If we just go to the next page, so these is the sale volume that happened in the triangle. So you have Triangle, you have Charlotte, you have Triad, our primary three markets that we participate in. This is a slide that came out that we grabbed recently, and it was just an update on the Triad, but I think it depicts everything that's going on. So the little dotted green line along there is sort of the trend line. It's just a linear trend line. But what you can see is historically we've been anywhere between kind of a billion to 2 billion. And then that was kind of escalating in 2019. 2020 is when COVID hit, and at the end of 2020 is when rates fell precipitously at the long, and people just bought a lot of assets. And the vast majority of those purchases were done with long-term fixed rate debt. But the syndicators who had really been participating since, call it, the early 20 teens, and had been generally in the market of buying and holding for 2 to 3 years, they oftentimes would be in bank or non-bank short-term floating rate debt that all started to come due in 2023, 2024, and definitely with extensions to 2025. And so what you can see is if let's just assume that maybe half of the 2021 and half of the 2022 debt is coming due right now, and it's on floating rate debt, they're probably very close to 80 to 90% loan to value, unless they've had substantial rent growth the way we have. And a lot of people don't seem like they have. They didn't have the capital plans that really helped carry them through that. And so we think 2025 is going to be a year where we're going to see a lot more forced sales. You're going to see lenders that have a desire to get out of their assets if they take them back. And and Eric will talk about this a little bit more, but we did buy our first asset recently, and we did it in a really novel way. But it's the first asset we bought in 2 years, and we feel extremely good about that. So with that, I'm going to turn this over to Eric Stamp, the Chief Financial Officer of the REIT, and he'll go through a little bit more detail for you.
Yeah, thanks, Bill. Again, I'm going to go over the results of 2024. We'll get into the balance sheet, our debt, and then we'll share a NAV update for everyone. But regarding just basically a comparative overview of what our financials look like, and kind of going through and understanding the different reporting groups of our financials. Historically, we've reported on the consolidated group, which is the GAAP financial statements, which you see in the audited financial statements. They don't represent the portfolio well. They kind of exclude, you can see in the unconsolidated group, almost $66 million of revenue that gets reported in a single financial statement line item. So we're kind of moving our reporting to more of the combined portfolio, which includes any asset that the REIT has an ownership interest in. So that's basically $100 million in revenue and almost $1 billion in asset value. And this is basically how we internally view the portfolio day to day, how we underwrite, manage, review, and get a good indication of how the complete picture of the portfolio is working. The consolidated group, again, is our GAAP consolidated financial statements. They don't represent the whole portfolio, as the JVs are not included in the actual accounts, but more at a bottom line representation level. And then lastly, we have the proportional ownership, which is actually included what directly the REIT owns in both of the consolidated and unconsolidated groups. So that's about a little more than 50% of the total portfolio, and represents about $50 million in revenue. But moving forward, we're reporting more on to give you as shareholders a better picture of what you're invested in and what the portfolio is actually doing. So as we move in to the next slide, we can actually see proportional ownership of what our earnings did. And as Bill alluded to, we had a strong operational year. Again, revenues for the proportional group, increased 4%. We had rents per occupied unit increased 7%, which again, with some losses, connection losses and occupancy, represents a 4% increase in revenue. Again, Bill mentioned this, but we did over 550 unit renovations. We're generating premiums of $200 plus on those renovations. So from a NOI and an EBITDA perspective, we thought we performed well this year. We had some, as we move in from EBITDA to AFO, we have some challenges from the capital markets perspective. Interest expense increased, 13-14%. So as an underlying factor, AFO and our earnings per share declined slightly year over year. But as we move to the next slide too, we can show the balance sheet and kind of what we expect moving forward. We don't expect a lot of more interest expense growth. We're continuing to work on our leverage profile. It's a little 63% today. It's a little uptick from 2023. And a lot of that is we retired the line of credit onto mortgages, which increased some of the refinance proceeds, but also significantly reduced our borrowing cost, close to 200 basis points on those refinanced assets out of the line. So very accretive for our balance sheet and our financial position. Again, as Bill mentioned, we did finally complete an acquisition in about 2 years. We did do it in a unique way. We had a large institutional investor come in and do the transaction with us. It's a 219 unit apartment in Wilmington, and we did it in an all-cash transaction. We just felt right now, along with the partner, it wasn't the right time to finance the property. It'll give us a little bit more leeway in the future to kind of find the right terms, the right rate. But it's just one of the things that we're doing to kind of work on our leverage and continue to target the portfolio between 55 to 65%. And again, with the line of credit, the retirement in 2024 was really accretive to our balance sheet. We took off, we introduced the notes program, which has been a favorable trade-off for both our investors and the REIT. Investors are seeing rates that they can buy or receive these notes at almost 150 to 200 basis points more than they would see from a bank CD. But then from our borrowing costs, we're saving close to 150 to 200 basis points on our end. A lot of this is due is it was a $50 million facility. At any given point in time, we were holding about 25 million. So we had a large unutilization fee that was just costly for the REIT. So we retired that, introduced the notes, and it's been a great trade-off for both us and our investors that have elected to participate in that program. As we move to the next slide, we could kind of talk about what we've been doing in 2024 from a debt standpoint. We've done a lot. We've almost refinanced or extended $100 million in debt. Most of that is beyond 2029 and all from floating rate to fixed rate. So we think very accretive to our balance sheet. Again, as Bill kind of mentioned, we're not trying to play the interest rate betting game. We want stability for the REIT. We want to know what cash flows we can expect from a debt service standpoint. So it's been a good year for us in moving debt outward and helping us ladder our maturities to basically reduce any near-term risk. The remaining 2025 maturities there you see there are related to 2 assets. They're both with a single JV partner. They're 2 assets that we acquired in 2022 at a pretty low cap rate, about 4.25. Today we're about 100 basis points higher than that, 5.25 or 5.5. So it will require a larger pay down for both the REIT and our partner, but we still see substantial value. And the REIT has a couple of mechanisms to help provide that liquidity both through our balance sheet and some contingent liquidity that we have. But any reduction in value we've kind of realized over the past year. So shareholders have kind of incorporated that in the reduction of value over the past a year. But we still see potential upside in these assets. They both have very extensive capital plans that are starting to become realized. So any improvement in operation and value there will just be beneficial to shareholders. They see it through capital appreciation. And then discussing our NAV. We move to the next slide. The board convened a couple weeks ago and determined that no change to share price was warranted. This was a little surprising to us, is that the Q4 cap rates actually came in a little higher than Q3, about 15 basis points higher. But we had some really strong performance in Q4 to help offset those increases in cap rates. Almost a 7% increase in Q4, which is, for people that are familiar with the multifamily sector, it's generally a slower time of year due to seasonality. There's not as much leasing momentum, but it was relatively strong for us. And we saw a 7% increase quarter over quarter. The board also voted to continue the dividend at the same price at 130, or a 5.6% yield at 136. And that'll be for Q2, so May through June. And for our tax equivalent or a tax advantage dividend, that represents a 9% plus. So that's basically a yield that investors would have to receive on a taxable investment to receive the same dividend yield that the REIT pays. And overall, our outlook really does remain really positive. We have, going into Q1, really strong momentum from our performance, from cash flows. And if we see just a little bit of ease in interest rates, we think there's going to be some significant pickups in our joint ventures and our promotes, which we can kind of continue to talk about as we move to the next slide about our appraisals. Again, this kind of basically provides a timeline of basically the cap rate expansion starting in 2021 to where we are today. As you can see, cap rates back in 2021 were almost 100 basis points lower than where we are valued today. But on the back end of that, we've seen some significant growth in our NOI, almost 22% over that same period. While cap rates have still increased at a faster pace than our cash flows, we're starting to finally see some offset there. And for the first quarter since 2022, we actually had an increase in our appraised values. And again, that's all due to cash flow growth over our own assumptions, but also our appraiser assumptions quarter over quarter. So we really truly believe that there's a lot of value in our portfolio. There's still a lot of growth potential that we see, especially possibly in the near term from our joint ventures. Again, at these cap rate levels, it's hard to dive into the promotes. But if we see some ease of interest rate pressures, the REIT is invested in the GP position of pretty much every single joint venture we have. So shareholders are directly invested in the GP. They receive the promote interest, where other fund structures, they're generally sidecar to principals, or the sponsor receives those promotes. You as a shareholder directly receives any promote or performance gains from the REIT. So we really believe that the joint venture value that we have could be substantial to our value and our growth. But that's what I have on the NAV. So I'll pass it over to Rada to discuss performance and some of our capital raising initiatives.
Great. Thanks so much, Eric. And just a quick reminder, submit your questions in the Q&A box, and we'll tackle them towards the end of the session. So now I get to talk about an exciting topic, which is our historical returns. Certainly don't want to overshadow the fact that the total return for 2024 was a negative 1%, but we look at real estate as a long-term investment. And when you look at Ginkgo REIT's performance relative to peers, we've certainly outperformed all but one public multifamily REIT out there. We'll touch upon this in one of the future slides, but not only did we outperform, but there was a lot less volatility, a lot less noise when you compare ourselves to the public REITs. So this slide here shows a hypothetical $10,000 investment at the inception of the REIT of July 1st, 2019, compared to the aggregate public multifamily companies. So meaningfully outperforming public comps. How did we fare against some of the non-traded REITs? These are a handful of the largest non-traded REITs out there. Again, we've outperformed them as well. It's also worth noting here that these REITs are a little bit structurally different than our REIT. There are various classifications of shares. There's upfront fees, ongoing costs, which could impact returns. We've taken the gross numbers here. And just to highlight as well, this is total return, so NAV appreciation as well as dividends. Here's a metric that we've recently introduced in our latest shareholder report. When evaluating returns, it's also important to look at risk-adjusted returns and performance there. We know that the stock market has had a couple strong years of recent, and we also know that it's been pretty volatile, especially right now. I mean, there's definitely a lot of geopolitical headlines in the news happening today. And what we've done here is basically analyze the daily standard deviation across different asset classes. So if you look at Ginkgo REIT's standard deviation, it's significantly lower than private commercial REIT funds, which is noted as the NCREIF Odyssey Index. We've also looked at the public REITs, which is noted as the NAREIT, the NAREIT's All Equity Index. And the flip side of that is if you were invested in bonds and treasuries, you might have missed out on some of the gains, but you also took on lower risk. So bottom line, risk-adjusted returns matter when you're evaluating performance. Okay, as many of you know, 2024 was a pretty challenging year for non-traded REITs on the fundraising side. Just some stats out there. 6.1 billion was raised, which was the lowest level in 5 years. The high water mark was 2021. The redemptions hit $13.5 billion. So if you do some rough math here, $5.5 billion of negative fundraising occurred last year. It is very clear that the largest non-traded REITs are dominating fundraising, and correspondingly, there's been a lot of consolidation in the industry. If you've been following it, just a couple data points over the last quarter. Barings recently acquired Artemis, and Apollo recently bought Bridge Invest. So two highlights in terms of consolidation in the space as the big are getting bigger. As it relates to Ginkgo REIT, we had a strong year of capital inflows. It was up 23% year over year. That's if you include common, OP, preferred, and notes investments. The fourth quarter of 24 was particularly strong. It was up 3.5 times when you compare the fourth quarter of the year prior. There were a couple reasons that drove this strong capital raise towards the year end. We had our warrants program expiring, which many of you participated in. We had a couple 721 exchanges happen. And to Eric's point, Ginkgo Notes continues to be a very popular tool for investors to access as well. In terms of opportunities that we have live on the platform, obviously Ginkgo REIT is available on a monthly closing basis. Currently, the share price of $136 translates into a 5.5% cap rate. So that's certainly an attractive entry point for new investors or a re-entry point for existing investors. To Eric's point, we have a 5.56% dividend, which because it's a return of capital, you're looking at a 9.5% tax equivalent yield, depending on which state you're in. Ginkgo notes, we have our Series 3 12-month notes live in the market, allowing investors to receive up to 7.04% if you're in the top tier of the investment amount. This is a great short-term product if you think there's some geopolitical risks, or if you're just wanting to park some capital for the time being. And just to remind everyone, go to Ginkgo Vest if you're interested. Click on the invest button on the top right hand side. You'll see the two cards there. Both of these opportunities have a closing at the end of the month, so March 31st. And we are kicking around the idea of potentially doing another preferred offering. It has a unique structure, which is a fixed to float structure. So while we're in early discussions here, schedule some time on my calendar or the investor relations team. Happy to walk you through just the preliminary structure and give you a sneak peek. Yeah, so just to summarize, Bill's and Eric's presentation and mine, we've had a strong year of operations, but it's been a challenging capital markets environment. We feel optimistic about 2025. We feel that rates may stabilize. We're taking a very much proactive measure to refinance a lot of our portfolio, extending, improving our cost of capital. In talking with our acquisitions team, the acquisitions pipeline is robust, especially as debt maturities start to take effect. And while we don't have a crystal ball, our historical track record is solid. And from our team's perspective, we continue to focus on engaging with investors, improving the experience, and looking to innovate on new products as well. So with that, we will dive into some of your questions. So let's see here. I don't, Bill and Eric, you can see any of these, but I'll just read them out here. Are you confident that lenders will loan us the funds needed to refinance 2026 debt? How much do we have to pay down on the loans to refinance, and how will we come up with those funds? Thanks.
We have 3 loans that have maturities between now and the end of the year. We are in conversation with the existing lenders in all cases to see if they have interest in extending. They're all case specific, but in general, these are all joint venture assets. Our participation in those joint ventures is low end, I think 10%, high end 40%. And on an aggregate basis, it's really going to just depend on what happens between now and those maturities. But it's bigger than a bread basket. I'd say it's probably bigger than 5 million, but not dramatically higher than 5 million for the Ginkgo REIT side. And where we expect to get those funds is through capital raising, debt equity. And ultimately, what's interesting is what we're delevering is pretty, it will be pretty accretive to the REIT because the financing rates will be lower. Whatever the refinancing rates are, if we go today, we would end up with financing rates that will be lower than the floating rates with the caps that we have in place in all cases. With the buy down, we'll probably, in today's market, we should be able to accomplish something less than a 5.5 cap. And so even with the equity we put in, if we're paying down something that's valued at a 5.5 cap and we're financing with something less than 5.5, the additional capital we raise should cover the short-term dividend. And depending on if we raise it with preferred, with debt, or with equity, in most cases and in most scenarios, we expect to have a total return that's greater than 11 to 12% on the investment over its life. So even if there is a short-term disruption, if it's straight preferred or straight common, but if there's not long term, these should be very, very accretive pay downs.
Great. Thanks for that
Yeah,
explanation,
the only
Bill.
thing I was going to add to that, which Bill kind of added at the end, again, anything that's maturing for us outside of 2027 is all joint venture debt. It's all floating rate, which will allow us the ability to talk with our partner to refinance all of this to a fixed rate financing, which will again provide stability for each of these assets and lower the borrowing costs substantially, both through our own interest rate, but also the requirement in the past that we've had to fund these interest rate cap escrows, which can put anywhere of our floating rate debt an all-in rate of higher than 8%. So getting out of this floating rate debt and into the fixed rate will align with our overall initiative of the REIT, but also just be accretive to the REIT's balance sheet and stabilizing cash flows.
Great. Thanks for that explanation, Bill and Eric. We have another question in regards to insurance increases. How are we anticipating that? Do we have any hedges in place to protect ourselves?
So in terms of insurance in general, most of the noise associated with insurance has actually happened. I believe we're up on a premium basis over 3 years, about 80%. I'm not quite sure what that is. And I know that the consumers have been hit with this much later. So autos and homes have come up more recently, but the commercial industry bore the brunt of this 2 years ago, where we saw substantial increase. I think we saw a 50% increase 2 years ago. With it, it's a material, but it's not a substantial part of our expense load. It is, I want to say, I think it's about 8 or 9% of our expense load. I could be wrong on that number, but our financials that we provide in our annual report will give you a little bit better clarity. It moved enough that I don't really know it anymore. What I can say is one of the things we did though to protect the REIT, and this is Ginkgo Residential, we were individually insured, and that market for a long time was going asset to asset was better than pooled risk, where you were getting sucked in to fairly excess lines for hurricane and stormwater and things like that. So we'd gotten out of blanket policies, but approximately 12 months ago, when our renewal came up, we elected to go into the pooled market, and Ginkgo Residential actually bought the top slice of that risk to lower the cost for the REIT. And what we effectively did is we disintermediated the cost of having a broker involved. And so we stepped in, we being Ginkgo Residential, stepped in and capitalized an entity with reinsurance on top of that took substantially most of what would have been paid in a commission out. And it kept our premium. I think our premium might have gone up like 8% last year, 10% last year after we did this.
Yeah, less than 10.
Yeah, but it was going to be more than 20%. And what that did is we have per incident, we absorb everything above the on-site's requirement for $25,000 up to a number, and we have a limit per year, and we have sufficient capital to cover that. So Ginkgo Residential did that. The REIT can't do that for itself, and the reason why the REIT can't do it for themselves is A, they're not an insurer, and it would go into the bad income bucket, but B, it's also providing services to the joint ventures which are not technically self-insuring for their own portfolio. So Ginkgo Residential agreed to take on that liability and pass most of the savings back to the company. I'm not aware of any way to hedge it, though. I mean, we could go out and buy a lot of reinsurance companies if we wanted, but we'd probably pick wrong, so we're not going to try that.
Yeah, great questions. So definitely keep them coming. Might try to bundle these two together just because we have a couple coming in. With all the consolidation going on in the industry, would Ginkgo ever consider selling while also growing our portfolio? Maybe just to add another, are we considering offering the warrants again as part of the REIT purchase?
So relative to the warrants, we are 100% indifferent to what is the capital that we solve for. We think it's important, though, that we develop a wider range of offerings so we have something to offer everyone at a given point in time. And so I don't see any reason why the warrants program might not come back, but I can't commit to it right now. It is not currently on the table. I think Rada indicated that maybe the preferred might be more close on the table, but we're trying to get reverse inquiries to see where that might work and how that might work. Relative to consolidation, We have not had anybody come to us for a portfolio. We have an incredible number of reverse inquiries that come in asset to asset. We've typically not engaged with that unless it's an asset we're already going to sell. But the reason we don't engage with that is reverse inquiries on assets and reverse inquiries on companies typically turn the negotiation to an auction of one party. So you start to become invested with one party, and you lose your leverage in the market. So to the extent we're going to sell, we would market the transaction. To the extent we had an interest expressed to buy the company directly, we would probably hire, and it was a level that the board thought was a suitable level, we would probably engage counsel to do that. Having said that, if you look at the history of the legacy company and partners who are still here, Eric Rom and Scott Wilkerson, we top ticked the market in 2007. So you're not going to find another multifamily REIT. You're not going to find another REIT that actually closed and set a record at the time in terms of a premium over where their price was when the process started to when it closed. And we closed in February of 2007. And the reason the partners elected to sell at that time was it came down to fundamentals. And the fundamentals at the time were really simple. And that was you had only about 91% annual national occupancy, 91, 92%. We were turning down one-year leases to people with bad credit who in turn would go buy a house with 100% down and oftentimes getting money at the closing. And it just looked unsustainable. And again, that would have been in the 2006 process. So we would definitely do that. What we see right now that's very different, though, is this appears to be a lot more of a capital market driven event. While we do have some supply issues in Raleigh and Charlotte, which have some legs to it, we're still seeing very positive momentum across our portfolio. Our bigger challenges right now are literally just having to deal with our joint venture debt. Our fixed rate portfolio, which is our consolidated portfolio, continues to have very strong year after year results. Our joint ventures actually have better top line results, but it's just the debt catch up that's hurting it. So for us, momentum wise, I actually think this is as good a time right now as ever to be a buyer, because I think this is literally the market where the proverbial joke about you don't have to run faster than the bear, just faster than the guy in the tent with you. Well, I think that really is the theme of where we are, and I think we're positioned to run faster than many of the people that are next to us, and we will pick up assets, and other people will also pick up assets in what is clearly a recession in the multifamily industry in the near term. It will give us an opportunity to pick up those forced sellers.
Great. Thanks, Bill. Yes, certainly share your sentiment about the warrants. I mean, definitely a strong close going into the end of the year, but encourage all of our investors and prospective investors to reach out to the IR team just to chat about how you're viewing the world. If there are any opportunities that are coming down the pike for us. Yeah, so one last question I'm seeing here, as it relates to for selling that could potentially happen this year. What are we seeing in terms of the pool of competitive buyers? What do they look like? Are people showing up to the table here?
So we are selectively looking to sell a joint venture asset we have right now, and I will probably have better color at the end of this week. To the extent we sell that, some of those proceeds could be used to fix some of our capital needs. We don't have a substantial investment in this asset, but it is we have a joint venture partner who's reached their end of their cycle, and so they're asking us to sell this. We're seeing it again. This is the universe of one where we're on the other side of the screen, but what we're seeing right now is a very robust group of people that have gone into the war room, that have actually, toured the asset, et cetera. And, I don't know how many bids we're going to get, but if I was to go on a general basis, I could see us getting 20 to 30 bids with our call to offer coming later this week. But it could be five, maybe everybody's just kicking the tires. I don't really know. What I can tell you from the other side of the equation, though, is we looked at over 200 transactions in the last 9 months. We issued LOIs on maybe 20. We got invited into best and final on 4 to 5 of those. And in many cases, even in the best and final, you go through the best and final, the seller just ultimately said, we don't want it to trade. It's not, it's not getting to the level that we need, and et cetera, et cetera. And people look at, the amount of money they might get out of some of these things, and maybe when they get out to the reality of losing that money, that most of these people who are for sellers who are losing money are looking at, they just get shy. And so the brokers are getting fairly frustrated. There's a fairly large brokerage in North Carolina that I think they've had failed auctions 3 or 4 times in a row, where they've gone through best and finals with people, and the seller has elected not to go forward.
Great. So I know we're coming up on time here. I'm not seeing any other questions, but yeah, I just want to thank everyone for joining us today. Thank you for your time. And maybe just kick it back to Bill if you have any sort of parting thoughts or words for our investors or prospective investors.
No, just thank you for your time. Thank you for your faith and confidence in us. We appreciate everything you've done. There were excellent questions, particularly about, our really it came down to, are we a buyer or a seller? And we were clearly neutral for the last few years, where we just, nothing seemed to make sense. I think going through and buying the transaction we did, where the seller's basis was 42 or 43 million dollars in a transaction they purchased in 2023, and we bought it for 31 million 5, and they stepped away just because they could not write an $8 or $9 million check to delever down to a level that worked. uh, there's more of those out there, and that deal was good enough, as Eric indicated. We were able to find capital that agreed with us, that we thought just owning it unlevered was a good enough return in the near term, and we could time when and if we want to ever put debt on in the future. And so we think that there's going to be more opportunities, and potentially more opportunities with that joint venture partner who wants to buy all cash. So we're a
Great.
buyer, right?
All right. Thanks again,
Yeah,
everyone. We'll have the
I just have one
presentation.
final thought, Rana.
Yeah.
We issued our annual report last week, and we would love for our shareholders and to read it, give us feedback. Again, we've structured it a little differently as I kind of went through our comparative reporting, and talked a little bit more at the combined portfolio level, to hopefully give investors a better indication of their holdings in the REIT. And a lot of today was summarizing, discussed that report, but we encourage everyone to read it and provide feedback on our report and what we can do better going forward.
Yeah, it's a really good point. And in case you missed that email, you can also go to ginkgovest.com, click on the REIT card on the offerings page, and towards the bottom, you can find the very lengthy 60-page, very robust report there as well. So thanks again. We'll circulate this webinar to everyone after. But thanks again. I hope everyone has a great day.